We have the yield curve inversion this morning. The market responding. What do you make of it?
I mean, quite honestly, think about this. I mean, what really changed today? I mean, the yield curve, the 2 and the 10 did invert, but the 3 and the 10 has been inverted for quite a long period of time. I mean, part of this is you're getting, people are just getting whipsawed daily by things that are impossible to predict. The tweet yesterday that tariffs are getting postponed until December 15th. I'm not sure what exactly changed in the 2 weeks from when we talked about tariffs being put on in September 1st. So you've got all of this stuff going on. So the market's up, over 1.5% yesterday on the S&P. Today it's down 2%, and you're just going through this violent churning, and it's causing huge issues for people who are trying to participate because it's very hard to focus on the fundamentals when you're continually getting whipsawed by all this policy uncertainty. So, we went into yesterday, we were sitting in our hedge fund in about 5-6% cash. When the market ripped up yesterday, we increased our cash position to 12-13% on a net basis. So, for us, we're trying to become, much smaller, play in less positions, and in stuff that we're more convicted in. But, this is the toughest environment to invest in that I've seen in the last 20 years because of that kind of policy uncertainty that we haven't had in the past.
Last 20 years, Dan, I mean, you've seen some crazy cycles. This is more difficult to navigate than dot-com boom, than financial crisis?
It is, because here's why, in my opinion. Back then, one of the best pieces of research I wrote when I was a research analyst, I wrote it in 2001, I think, and it was called Don't Fight the Fed, We Say Don't Fight the Fundamentals. And what we meant was you could focus on the fundamentals, you could just invest off of that, you knew things were going to get bad in 01, 02, and that's what we stuck with. We didn't upgrade a stock for, over a year during that period of time. But you had a very clear direction in that you were more focused on what the Fed was doing. The problem now is you look at it and you say, okay, we're going to put tariffs on 2 weeks ago. No, we're not. We're going to push it out to December 15th. These things keep changing, it seems like, on a daily basis in some cases. And so it's making it very hard to deal with that because on the one hand, you do have the Fed, well, actually you have central banks all around the world easing. And so that's pretty clear. The bad news is the policy decisions keep switching back and forth, and these are big ones, right? When you're in a trade battle with China, if you knew that, you're going to put on tariffs definitively, you could at least invest based on that. If you knew that we were all settled, you could at least invest on that. The problem is you're not really sure what the environment is, and it changes on a weekly basis. And that's why I'm saying it's actually more difficult because you can't just focus on fundamentals and go with that. You've got all of this other stuff that's whipsawing, very consistently.
So, Dan, in light of that and the fact that you've increased your cash right now, are there certain names or certain stocks, certain sectors that you would be looking to put that money back to work in if the price was right? Or are you just going to sit on the sidelines increasingly right now because of all that uncertainty?
No, I think, I firmly believe you want to invest when there's blood in the streets. There's not blood in the streets right now. Yes, the market is down, but it's not down that much. And so you haven't, I forget who said it, one of you said it, but, there's been sort of this buy the dip mentality. And that's dangerous because then you feel like, well, I'm immune. I'm never going to lose any money. And that creates people that really aren't invested because they have strong fundamental convictions. It's, the Fed's going to save us, so don't worry about it. That's not a good reason to be in stocks. And if you look at the S&P's up 14% year to date. The Nasdaq's up 18% year to date. The semi-index is up 25% year to date. So there's a lot of people sitting on some very big fat profits in big indices. And other regions of the globe, Argentina obviously yesterday, may have suffered humongous losses. But we haven't in the U.S. We've made a lot of money, so there's not enough pain being inflicted right now to make me say, okay, I want to wholesale jump back into stocks. If you look at my Twitter feed, at Daniel T. Niles, you'll see that on December 24th, I was like, you know what? We're down to one short. We've gotten really long. I think we had an interview with you at that time. We really got ourselves aggressively long, but that's because we had been in the worst fourth quarter since Pearl Harbor got bombed. So that's a different situation. Right now, that's not what we're sitting in. So yes, I am looking to deploy cash, and the names I'm focused on are the ones that are not involved with China, that are not hardware related. I'm looking at more of the internet names that aren't affected by this as much. They don't care about tariffs. Those are the ones, the Googles and the Facebooks of the world that we're interested in, and sectors that are secularly growing versus things that are challenged. Like I look at oil and gas, and it looks interesting on a valuation basis. I look at banks, that looks interesting on a valuation basis, but secularly lower interest rates are terrible for banks, and if we go into a recession, that's bad for oil and gas. So those are things that we think about a lot more, even though they look extremely cheap.